Is private credit opening up cracks in the US banking system? This is Sectors Up Close, and we're talking US banks. When car parts conglomerate First Brands Group went bankrupt in October, owing $12 billion, JP Morgan CEO Jamie Dimon said that where you see one cockroach, there are usually more, leading to concerns banks may have opened themselves up to too much risk coming from the private credit markets. When they reported for last quarter, though, bank CEOs sounded confident there's nothing to fear. So are US banks undervalued? Adam Phillips is Managing Director of Investments at EP Wealth Advisors. Firstly, Adam, how worried should investors be that loose lending standards in private credit could end up being expensive for banks?
Right now we think that this is really an isolated event. We do think that there could be some more cockroaches here. We don't think that it's a full-blown infestation, though. I will just note an article that came out late last week showed that two major players in the private market space actually had very different valuations for the same loan. And so I think that the scrutiny on private credit is certainly warranted, but do we think that this is going to be something that spills over into the banking space? I don't think so. We've seen since the financial crisis that underwriting standards have really tightened up, and I think that's going to serve banks well here in this environment.
Corporate bankruptcies have been on the rise in the US, though. Do lenders have enough set aside for potential loan losses?
No, I think that's a good question. We saw that at least in the latest round of earnings in the third quarter earnings season, which is just finishing up this week, we saw that banks actually showed that from a credit standpoint, things look pretty good. They were actually reducing the amount of net charge-offs and loan loss reserves. And so I think that that bodes well. It shows that they have confidence in the system right now. It is something that we watch every quarter. And so we will look. I think this is a moving target for them. And so, but for now, I think that they do.
Now, I know you think the financial sector is undervalued, that the market could be more bullish on it. Why?
Yeah, well, look, it's been over a year now since the November election last year. And coming out of that election when President Trump was elected, we saw that financials were really one of the main bright spots. Everyone rushed in. We thought that there was going to be deregulation. We didn't see it. And now fast forward a little more than a year, and financials have underperformed the broader S&P 500 by a fair margin, by about 5%. And so they are lagging. What we're looking for going forward is that from a valuation standpoint, this is a sector that is punching well above its weight. It accounts for about 12 or 13% of the overall S&P 500, but contributes about 20% to overall earnings. And so there is room here for the sector to outperform going forward. As we think about the months ahead, now that we're getting past things like tariffs, like immigration, I think that we're going to move towards year two of President Trump's agenda. And that's going to really focus on deregulation. We're already seeing things like M&A and IPO activity start to pick up. So we expect that to continue. We obviously need the stock market as a whole to maintain its strength for the IPOs to continue. But we think that that bodes well. We also think that if the Fed is set to cut rates further going forward, and as soon as later this month, then that could be later next month, that could be another catalyst for the sector, because we know that as the yield curve steepens, that really bodes well for financials, specifically banks.
Going back to the yields picture, Adam, banks benefit, as you were saying, from lower short-term yields, but what if the Fed doesn't cut in December?
Yeah, that's a great question. We know that it's really a coin toss right now. The Fed may not cut. We do think that there's room to cut. If it's not in December, it could be early next year. The question is, how far do they go from there? A lot will depend on the incoming FOMC chair and who ultimately replaces Fed Chair Jerome Powell. But let's assume that they don't cut, or at least don't cut as much as the market is hoping. We do still think that yields on the long end of the curve could actually move higher. So even if you don't get the short-term yields moving lower, we do think this steepener trade and those areas of the market that will benefit from further curve steepening will actually see that happen. And so we think that that bodes well. Let's remember that banks in particular, they do borrow at the short term and lend at the long term. So a steepening yield curve environment is a positive for them.
That was Adam Phillips of EP Wealth Advisors. Don't forget, you can watch more videos on Reuters.com.